Welcome to The Explainer. Today we're unpacking a really specific and honestly an incredibly fascinating window of time, August 9th and 10th of 2026. On the surface, market movements can just look like this chaotic sea of green and red numbers flashing on a screen. But when we actually look closer, when we break it down, those numbers tell a profound story about exactly where the global economy's heading. So let's decode these seemingly complex market moves together. Okay, let's dive right into this. To really understand August 10th, we have to start with a central mystery. Why in the world did the tech-heavy Nasdaq take a noticeable stumble, while the broader market basically just held its breath? Wall Street didn't see some chaotic, widespread panic. No, what we saw was a highly selective shift. We're going to treat this session not as just random market noise, but as a fascinating puzzle. What exactly forced investors to pump the brakes on tech? Let's look at the evidence. Section 1. Market headlines for August 10th, 2026. Let's head straight to the scene of the crime to establish our foundational facts. Let's look at the raw data straight from the closing bell on Monday, August 10th, pulling from Wall Street Journal and Reuters. Take the S&P 500, hovering right near that massive 6,000 level, barely down a scratch at minus 0.06%. The Dow Jones, a similarly mild dip. But then look at the Nasdaq composite. It dropped 0.32% to close at 26,605. And the Russell 2000 small caps were actually the weakest of the entire bunch, down over 0.5%. Now, what is really interesting here is that stark contrast. A 0.06% drop on the S&P 500, that just means investors were taking a little profit at record highs. But a 0.32% drop on the Nasdaq, that tells us the pressure was highly concentrated in tech. This literally proves we were witnessing selective sector rotation. It was not a widespread market panic. People weren't fleeing the market, they were just rearranging their chips. The overnight preparations from Sunday really set the stage for this whole dynamic. Investors woke up Monday morning totally caught between two opposing forces. On one hand, you had the positive momentum from the previous week's massive rally. But on the other hand, they hit a total brick wall of Middle East uncertainties, plus some very specific weakness in the semiconductor space. When record high valuations meet new risks, the natural market reaction is, well, to consolidate. Moving on to Section 2, the semiconductor and AI effect. Let's zoom in from the broader market directly into this tech ecosystem to find our primary suspect. This brilliantly illustrates just how interconnected the 2026 market really is. The AI trade isn't just about some software. It is a massive, multi-layered capital expenditure cycle. Think about it. It starts with AI models, which require huge data centers, which are built on GPUs and semiconductors, which drain incredible amounts of electricity, all managed by massive cloud companies. So a drop in chip stocks isn't just an isolated event. It's a massive domino effect hitting that entire infrastructure chain. So, on August 10th, when semiconductor heavyweights like Intel and other vital chipmakers faced noticeable weakness, it acted like a heavy anchor on the Nasdaq. Because the market's 2026 rally has been so incredibly reliant on the artificial intelligence growth story, any crack in that hardware foundation naturally pulls down the entire tech index with it. Section 3, Oil, Geopolitics, and Inflation. To understand the rest of the market's hesitation, we need to shift our investigation to the Middle East. Take a look at this chain reaction. Over the weekend, uncertainties surrounding U.S. and Iran negotiations over the Strait of Hormuz hit the headlines. Because that strait is such a critical global energy choke point, any geopolitical uncertainty there instantly creates an oil supply risk. That drives crude prices up, which sparks inflation concerns, which ultimately squeezes equity valuations. It is a textbook example of how international politics mathematically impact your portfolio. When crude oil spikes, the impact is immediately split right down the middle. It is fantastic news for the energy sector, which obviously saw a boost, but for the rest of the economy, it acts just like a tax. It's negative for everyday consumers paying more at the pump, it hurts transportation and airline margins, and crucially, it deeply complicates the Federal Reserve's ongoing battle to keep inflation in check. Section 4, Treasuries and the Fed. You really can't understand the stock market without understanding the bond market and monetary policy. So the crucial point here is this specific relationship. When inflation concerns cause Treasury yields to rise, the present value of a company's future cash flows mathematically falls. For high-growth, high-valuation companies like the ones making up the bulk of the Nasdaq, this is a massive deal. Their valuations rely heavily on earnings far out in the future. When yields go up, those future earnings are suddenly worth less today, which instantly makes the stocks less attractive. And the market is always looking ahead to the Fed. When we look at the calendar, the last FOMC meeting was back in late July, and the next rate decision wasn't coming until mid-September. But the minutes from that July meeting were scheduled to drop on August 19th. So even without an active meeting on August 10th, the impending release of those minutes acted as a huge catalyst. It forced investors to constantly reprice their expectations of future rate cuts. Section 5. Bulls versus bears. With all these moving parts, the tech weakness, the oil shocks, the Fed anticipation, let's summarize the opposing forces battling it out on Wall Street. Weighing the evidence here, the bulls absolutely had ammunition. The S&P 500 showed incredible resilience. Long-term AI infrastructure spending is a very real structural theme, and corporate earnings were generally supportive. But, the bears had a really strong case too. Valuations were highly elevated, market leadership was dangerously narrow, meaning just a handful of mega-cap stocks were holding up the indices, and geopolitical oil shocks threatened to totally upend inflation data. Section 6. Professional Market Analysis Tools. Let's see how we can actually apply this data practically to analyze these complex conditions like a pro. This represents arguably the single biggest aha moment in finance. The price of a stock today is not a reward for what a company did in the past. It's a price tag for what the market expects it to do in the future. This is the future expectations price. If a company reports a massive 40% jump in earnings, but Wall Street was already pricing in a 50% jump, that stock's going to drop, period. Which leads us straight to the golden rule of Wall Street. A good company does not automatically equal a good stock. Let me say that again. A business can have a brilliant product, incredible management, and growing revenues, but if the equity is massively overvalued based on completely unrealistic future expectations, it's a bad stock to buy. This perfectly explains why the Nasdaq, which is filled with great companies, saw that valuation-driven pullback on August 10th. To find out if a good company is actually a good stock, you have to dig through these 7 layers of fundamental analysis. You start with a business model, move through revenue and profit, verify they're actually generating real cash flow, check the debt on the balance sheet, calculate their valuation compared to peers, and finally, weigh all of that against the market's expectations. You literally have to move far beyond simple headline revenues. And where exactly do you get all this information? You follow this flow. At the very top, the absolute truth are your primary sources. We're talking 10K and 10Q filings from the SEC Edgar database and direct Fed or Treasury data. Below that is raw exchange data. Then comes reputable journalism like Bloomberg and the Wall Street Journal to provide the context. And at the bottom, analyst opinions. You must always verify an analyst hypothesis against that primary source data. To efficiently process all this, you can stack specific analytical platforms. You've got FinViz for rapid market mapping and sector screening. Really lets you see where the money is flowing. Koifin is fantastic for building out institutional-style macro dashboards. Macro Trends gives you that vital 10-year historical context on valuations. And platforms like Ticker, they are absolutely perfect for deep company-level fundamental research and pulling up those raw earnings transcripts. Which brings us to the ultimate question. August 10th showed us a market in a very delicate balance, consolidating record highs while trying to digest geopolitical threats and semiconductor weakness. The board is set. With inflation risks rising and tech valuations squarely under the microscope, the release of those upcoming Fed minutes is guaranteed to send ripples through the ecosystem. Using the tools and frameworks we've outlined today, the real question is, are you ready for what the market does next? Thanks so much for tuning into this explainer, and we'll see you next time.